Would you say the rates, obviously that's a big, big talking point right now, whether it's conventional or hard money. Would you say the rates tend to trail or follow the Fed similar to conventional? For instance, if you have a 7% rate for a conventional and let's say a 12% for hard money right now, is there a typical spread you would see between conventional to hard money, like of that 5%, or kind of how does that normally track, just so that people could follow along and set an expectation there?
It's a great question. So usually what you'll see is the 30-year loans follow the 10-year treasury. And that's pretty standard. That's why a lot of people, when the Fed increases their federal funds rate, which is the rate at which banks borrow to one another, that tends to impact the 30-year loans. Now, the 10-year treasury, and the reason why we can't accurately put a spread between conventional and hard money loans is because hard money loans are actually pegged to a SOFR rate. So a SOFR rate is a different metric that banks use, and it's usually a spread of 4 to 5%. And that's a better depiction to understand where hard money and, as a matter of fact, new construction hard money loans are trading at. So when you think 30-year loans and what's going on with the trends, think about the 10-year treasury. And then when you think of hard money, it's SOFR rates plus a 4 or 5% margin.
Gotcha. Okay.
Yeah.
Interesting. I didn't know how that worked.
Yeah, there's definitely a second metric out there. Not a lot of people know, but it exists.
One of the things that I really like about my experience in working with hard money, it kind of reminds me when I was doing commercial deals as well. When you're doing a conventional loan, the banks or the lenders are really just looking at your income, right? They're not really looking at the investment. But when you work with Israel or you work with somebody on a hard money loan, these are folks that are experienced in investing. Like Israel talked about his background in investing and construction, and really has another level of knowledge than maybe your traditional lender might have. So they're actually looking at that deal from a risk perspective for themselves to say, is this client's comps, do they make sense? Does the construction cost make sense for what we see as the condition of the property? Is the development potential what they think the development potential is that what we think it is as well? So they're actually giving you another set of eyes on your deal, which, it's baked into the additional fee in my mind, because you guys are actually, another layer of protection, because you're not going to give somebody, these 80 to 90% loans on a fixer-upper property unless you also see the potential in that property as well.
And there's countless times I've actually denied more loans than I've actually financed, which kind of makes sense. And oftentimes I'm actually helping clients negotiate the deals for them as well. So I'm telling them, hey, talk to your contractor, see if you can compress the costs, or you can subcontract some of the costs out, and then simultaneously bring the purchase price down so that way your margins get expanded. That not only helps the borrower, the investor, get into a better deal, but also it's a better risk profile for us. And if I see a client doing any deal at 90 cents on the dollar, meaning the purchase price and renovations or 90% of the ARV, I'm telling them to walk away. Even at 80%, if they're not a very experienced operator, I'm most likely talking them away from the deal. So just know that is very true. And we're helping them a lot of times, guide them through those situations.
For sure. Yeah. So if you guys are out there, thinking about whether to use hard money, conventional, conventional is great. If a deal is in a position to be financed that way, and maybe you don't need additional money for the rehab, or you're planning to use cash or some other form of financing, but don't be scared of the fact that maybe it's a little bit higher in points up front or a higher rate, because you really do need to look at that as a tool and a way for you to take down a deal that's going to set you up for success and potentially make you a great return on the back end. So similar to with rates being high right now conventionally, like that's just one piece of the puzzle, right? So don't be scared of the real estate market, whether it's a conventional loan or a higher interest rate hard money loan, just because of rate by itself.
And the other thing, Ian, is that as I mentioned earlier, hard money is a tool, and so is conventional. So conventional financing. So, give you a perfect example. If someone's looking to buy an ADU in the greater Seattle area and the main house is in livable condition, I'm advising my clients go conventional first. If you can do, if money is a problem, you can get in with as low as 5% down as an owner occupied property. You'll get the lowest down payment, lowest rates. So now you acquire with the conventional loan, and on the back end, once you're done with the condoization and permits, then you can go ahead and refinance just the main house and then get a hard money loan on the new construction build. So these are tools that you can combine them. You can do on one project, be taking out 2 to 3 loans. And that's exactly what a lot of the sophisticated builders in our market are doing. And as people are taking more ADU projects, we're combining programs all the time.